Chronert here at Post 9, who's been very patient with all of us, but happy to have you here so that we can get sort of an investor take on what to do with all this information.
So I think we're still looking at a period of what we'll call geopolitical uncertainty, and that's going to overhang valuations for the S&P. We know that investors tend to, sell uncertainty by the alleviation of the uncertainty. We're still in this uncertain mode. The way I'm thinking about it is contained versus escalate, and as long as this remains contained, I think that our view towards U.S. equities is in pretty good shape. That 4,600 target is still premised on some peaking in interest rates, that coming down, perhaps on some safe haven play here. But additionally, we think underlying fundamentals for the U.S. stock market are in really good shape, and we're seeing that through Q3 earnings so far. So contained versus escalate, what constitutes escalate so that it would impact the U.S. outlook? That's going to be a little bit beyond my pay grade in terms of, I don't think any of us know, but so we're going to be watching oil prices as a lead indicator on what the market's trying to signal on that, but it's just something that we're going to have to monitor. It's hard to presume a base case, and what we're going to presume, if you will, is it remains somewhat contained around the confines of what's currently being discussed. I think we heard that from the president this morning, that's where the focus is going to be. That said, very short term, I wonder if you're heartened by some of the improving breadth last couple of days. Not that it leads us higher, but does it reinforce, 4,300 as some support? Well, look, we've been saying 4,300 is a place where you want to buy. We've been pretty consistent on that. No reason to change. I think what we're saying and what you were talking about, before the speech was that, at the same time, we're seeing some of your economic activity indicators beginning to come through more constructively, which again, yes, it gives the Fed some issue, but fundamentally, it's a reminder that the broadening that we think is a big opportunity for U.S. investors continues to be in place, and that broadening is beyond mega cap growth in tech. You kind of think back to our focus on the industrial economy as a place you want to look as well. So 5.4% growth in the third quarter is what Atlanta Fed says. What does that do for your earnings expectations for not just this quarter, but the coming quarters? We're out there pretty aggressively with our 245 estimate for next year, and so I welcome that. Backs it up. Yeah, exactly. So I think, generally speaking, we think fundamentals are still in pretty good shape. It's just going to be a function of monitoring Fed response from here and the inflation trends. Yeah, because there's an argument that goes that the strength of the economy might make the Fed keep hiking rates. Catch-22. Then we get an increased chance of a hard landing again. Yeah, we took a look at that this week, Sarah, and we did some analysis. And you go back over the past 70 years, and I can point to over half of the time that the S&P dealt with a 4 to 6% nominal 10-year yield, it traded north of 20 times. So we think we have to prepare for a regime shift in terms of the way we think about the interest rate influence on U.S. equities, and that's going to be counter to what we've gotten used to for the past decade in the post-GFC timeframe. So what we're positioning for is, again, a new paradigm, if you will, in terms of how interest rates play through into U.S. equity markets. We're going to take the glass half full side and view it somewhat constructively from a fundamental perspective.